pleasure to welcome you to our first E-Axis webinar this year. I think this year is a very special year for all of us, for our generation. We now have an entire foot in the 20s, and the next decade is crucial for our history. I think we have now 10 years until 2030 to start implement and consolidate all the structural changes that are needed to set our economy on a sustainable path for the future. And as you all know, we started on quite shaky grounds. I mean, the COVID pandemic is still and will continue to leave profound scars on our economies and society. Vulnerable households and firms, I mean, those with a few financial safety net have particularly suffered in the crisis and will need a strong and sustainable recovery. And it's in this environmental and social context that we must re-examine and rethink the role of, I think, all our institutions that are governing us. And for me, central banks are not exempt from this re-examination. And they are not exempt because they, to my opinion, can contribute to the transition to a low carbon economy. Last year, during our seminars, we have discussed in length that climate change has an impact on monetary policy, an impact that central bank cannot ignore. But we also have seen that central banks can support the reorientation of financial markets towards the transition and help shifting the fund to sustainable industries. So I hope that the series of last year has allowed you to sharpen your knowledge on the economics of climate change and on central banking, as well on the interaction of these two spheres with financial markets. And we hope that this year our series will continue to help you shape your views on these issues. In the first webinars of this year, we would like to put the spotlight on concrete policy proposals that academics and researchers have suggested to central banks to implement and support the transition. There are several such proposals on the table regarding central bank asset purchases or refinancing operation, collateral framework, as well as for prudential regulation. We will, in the coming months, discuss them. And today, we will focus on one of these options, which is aligning the collateral framework of central banks on climate targets. And to discuss that, it's my great pleasure to welcome Pierre-François Weber, who studied this question very thoroughly in the last years and months, as well as Romain Schwarzman, his co-author. Pierre-François, it is a privilege for us to have you discuss this idea here. We know that you've been thinking a lot about central banks and climate change, and we really appreciate you sharing your views here. But before giving you the floor, I would like to start with a quick poll for the audience. So we ask you 3 questions. If you could answer them, so that will give us a lead to start this seminar. In the meantime, while you're answering, let me just introduce more formally Pierre-François. He's Deputy Director at the Monetary Policy Implementation Directorate of the Banque de France. So he is someone who knows a great deal about the plumbing of monetary policy, see how it works, and he has to deal with its implementation every day. And in addition to that, he is someone that has steered the work on monetary policy and climate change at the Banque de France or at the Eurosystem level in general. It's even more my pleasure to have you, Pierre-François, in this seminar, because you have clearly been an early thinker about climate change, and I also joined this statement to Romain, who has also been thinking about climate change issues and central bank for a long time. And then we always appreciate both of your insight on this issue. Just to tell you, prior to working on monetary policy issues, Pierre-François set up the macrofinance division at the Banque de France, and he has also been an active contributor to the analytical and policy discourse at European and international institutions. So let me give you the floor, Pierre-François, and we will comment the result of the poll maybe after your presentation.
Sure, with pleasure. Can you hear me? Just to check. Yeah, good, excellent. Of course, it's my great pleasure to be here with you. Thank you very much for the invitation, Pierre, and everybody from EAXIS. It's a real pleasure to be able to share the work we've been doing with some colleagues at Banque de France. And my colleagues who worked with me are Antoine Oustry, who's now a PhD student in École Nationale des Ponts et Chaussées, Bunyamin Erkan, who is working in the risk department at Banque de France, Romain Schwarzman, who you already introduced, Pierre, who's in the financial stability department working specifically on sustainable finance issues and climate change, and myself. I should stress, because this is important, this is really not what I'm going to present to you tonight is really not Banque de France view. These are not proposals from Banque de France. This is really our own views. Need to stress that. And then in terms of what I'm going to do in the next, let's say 20-25 minutes is to walk you through, maybe next slide. I'm sorry, I don't have the control of the slide, so thanks a lot, Adrian. So what I'm going to do is to walk you through some of the background of the project and its rationale, and then discuss a little bit some of the consideration related to the challenges of measuring climate-related risks that we took into account in the work we've been doing, and then briefly sketch what we have dubbed climate-hedging portfolio approach to incorporating climate-related risk in collateral policy. Then I'll show you a couple of stylized facts that come out of this approach applied to real data from the Eurosystem, and then draw some implication or discuss some implications of the stylized facts that we have documented, and I'll conclude. I'll do that as briefly as possible to allow for a discussion. And then maybe next slide, the first part of the talk. Really here, you could already move to the next slide. Really the key word for us, Banque de France generally, and this is an official view as a matter of fact, we feel that climate change is really an emergency, and there is really no doubt that it needs to be addressed as expeditiously as possible. On the slide here, you see a couple of well-known facts about climate change. I'm not going to go into details. I suspect that most people around the call know that probably more than I do. Climate change is really a source of ecological risks, and it may have multiple impacts from that perspective. This has been documented by the IPCC in various reports, including the one from 2018. Beyond ecological impacts, climate change is also, and we know that all now, a source of economic risks and human risks through food and water insecurity, rising inequality, rising conflicts, bigger migration waves, and the source of material losses. Maybe the next slide, moving to the central bank perspective on this. I think it's worth recalling a little bit where we come from. You all know that Mark Carney made a very strong speech back 6 years ago, nearly now, about climate change being a source of financial risk. And this has been echoed 2 years ago by the NGFS. I'm stressing here the NGFS because while Mark Carney's speech was really instrumental and really kicked off the discussion, the key element now with the NGFS that this statement, climate change is a source of financial risks, is now common view among central banks and supervisors. And that has been made public and stated in various reports, including one from 2019 by the NGFS. So far, most of the efforts in the central banking community and through the NGFS mostly has been about the prudential side, so to speak, of climate-related risks. It's only recently that the more monetary policy dimension of it has come to the fore. Some work has already been done, and you may have seen that beyond speeches, and you probably know the speech that are on the slides, one from Christine Lagarde, our governor has been vocal on the topic too. But some work, collective work among central banks has been done recently. Last year, the NGFS published a very short note on the macro implications of climate change for the conduct of monetary policy. There, the work really focused on, is climate change a source of consequences, may have consequences for the policy space of the central bank, for the monetary policy transmission channels, and possibly also for the design of the monetary policy framework and monetary policy regime. In parallel to that kind of work, as you're probably aware, lots of proposals, lots of contributions have been published about what central banks should do and how they should do that to green their operations. The range of policies that are under scrutiny is really vast. It covers collateral haircuts, exclusion, making some assets ineligible. It's also about greening credit operation. It's also about greening asset purchases and so on. So lots of proposals. And actually, in some work that I've had the chance to lead in the NGFS, we reviewed all these proposals, and we counted, that was back in June, we counted something like 50 proposals on what central banks should be doing. Maybe next slide. So against this backdrop, what we wanted to do was really to look at the issue from a central bank perspective. Most of the proposals that we've read, and I'm being a little bit schematic, but tend to approach the issue of what central bank should be doing from a climate perspective, which is reasonable. But as practitioners, we wanted to address the issue from a central bank doing monetary policy perspective. And we started from three premises. One is that, central banks as financial institution take on risks on its balance sheet through the conduct of monetary policy, through the operations. And central banks protect themselves against these risks that they take on through their operations. Second promise is that because climate-related risks because climate change is a source of of financial risks, central banks need to assess these exposures and have a sense of how vulnerable their balance sheet may be to climate-related risks. The third premise, and that is a very important one as practitioners and as monetary policy authorities, any actions that a central bank may wish to take to manage climate-related risks need to be compatible with either mandates and or the smooth conduct of operations. So really the goal of the paper is to explore how these climate-related risks could be assessed and actually, properly managed within the collateral framework. Having all these premises in mind, the focus of the project we've run with Romain and colleagues is really about transition risks. We didn't dig into physical risk for various reasons, because we were really short of time. You may appreciate that the work that I'm presenting tonight was actually done as the crisis unfolded last year. So we were a little bit busy doing other things in parallel, so couldn't look at physical risk. And we also thought that physical risk is a different animal in a sense. And so it's a different approach that you would need to think about. So much for Rationale. Then moving on to the second section of my talk. The next slides. Yep. Why did we pick alignment methods to sort of capture transition risks? Maybe next slide. There again, stepping a little bit back, a key point we think is important to bear in mind when you're thinking about climate-related risk, in whichever circumstances, but including when you're a central bank, is the extent of uncertainty that is prevailing when you're discussing, measuring, and monitoring climate-related risk. And this is true for physical risk, this is true for transition risk. I'm not going to go into the detail of this slide. It's just a highlight of some work that has been published, that have been published recently, that actually analyze this uncertainty surrounding risks, climate-related risk, whether physical and transition. Next slide. Yeah. So as I mentioned, keyword is really uncertainty, and that has implications in terms of how we want to assess, measure, monitor, manage climate-related risks. You need to account for the complexity of the issue. You need to account for the existence of multiple feedback loops. You must account for non-linearity, fat tails, deep uncertainty, and so on. This means, and I'm trying to move gradually to more concrete stuff, this means that typical backward-looking probabilistic approaches to risk are probably not fit for purpose when it comes to climate-related risks. Because of the reasons I just mentioned, complexity, feedback loops, non-linearity, fat tail, and so on, you need to have a forward-looking approach to climate-related risks. And you probably know the papers by Weizmann on this topic, and really nicely documents that capturing climate-related risk is really fraught with a lot of uncertainty, and it's really about digging into the tail of the risk distribution. The graph you see on the slide is, if I remember well, is an extract from the work from Romain and colleagues, the green swan, if I'm correct. So you may want to refer to that paper on these questions. Next slides, please. So having that in mind, these characteristics of climate-related risk, then the question is, how do you approach these risks if you're trying to embed any measure in your collateral framework to better manage and capture these climate-related risks? Here, the key message coming out of the NGFS is you'd rather go for scenario analysis. I'm not going to give you a talk on scenario analysis, but when we started work, the project work on scenario analysis, stress testing was at the very start, I would say, and we felt that based on the knowledge we had, that this scenario analysis was really being designed with a macro-prudential and micro-prudential perspective. And this is indeed what has come out of the NGFS so far. And in a sense, well, this is useful certainly to assess risk, but it may not be completely useful or not sufficient to try and capture climate-related risk in the collateral framework. Why is it so? It is so. Here again. I'm being a little bit schematic. I'm sorry for that. It is so because when you look at how you need to design a climate-related stress test, you need to have a macro model that ties the climate system with the macroeconomy, and have shocks there. Then you have to have a sectoral model that would be tied to this macro model, and then again a sectoral model that is tied to the individual issuer or assets. And at each step between this macro building block, the sectoral building block, and then the asset level building block, you're actually adding, each time it's a new model, and you're adding a new level of uncertainty in the results that you're getting to. And we felt that given the very nature of what is the collateral framework, collateral policy, which is very as precise as can be, very granular, asset by asset, issuer by issuer, that sort of approach, relying on stress tests, may be a source of fairly high uncertainty as to the actual result you're getting to. And so when we looked at this approach, we missed, in a sense, the issuer level perspective. Next slide, please. And that's where we turn to alignment methods. As you probably know, I'm not going to go into detail of what the alignment methods are, but as you probably know, what they try to do is really to assess whether a company, an issuer, has a business model and a business plan, actually, that is consistent with the smooth transition to a 2-degree world. Most of them, as far as we know, tend to rely also on scenarios, on those from the International Energy Agency. The key compared to stress tests is that they do not seek to value climate risk in monetary terms. So in a sense, they're quite distinct to what a central bank would typically use when it manages its own risk through collateral or asset purchases. Still, although it's not a monetary value of risk, we really think that these approaches, although they were not designed actually to measure transition risk, are a good proxy of that. You can really make the case that a business that is whose plan and investment puts it on the 2-degree transition path is most likely less exposed to transition risks than another one whose business model is more on a 5-degree path. And from that perspective, it might be useful as a proxy for transition risk. And you may have noticed that the TCFD published recently a consultation paper on these methods. And this consultation is backed by a paper from private investors who actually make the case, which I think is interesting. They really think of these alignment methods in terms of approaches that are relevant for assessing both risks and opportunities. So really, I would say in the same spirit as what we have been trying to do in the paper. I should stress that we are completely aware that these methods are quite diverse at the moment, that they are subject to a range of methodological issues. You've seen there was a very nice overview, or review, I should say, by the Institut Louis Bachelier that was published middle of last year. what they call the alignment cookbook, and they reviewed 12 or something like that methods and compare them on various on the given asset portfolio. So we are completely aware that these methods are not completely right at the moment and may give different results. Still, again, our sort of intuition that these methods, while a little bit complex and not completely right, from a collateral perspective, would remove, so to speak, some layers of uncertainty compared to other approaches being stress tests, which I think are still valid and needs to be developed further. But at the moment, they may be a source of increased uncertainty in terms of results, or other approaches which really try to get to the monetary value of climate-related risk. Next slide, please. Maybe I'll go very, very quickly, and I think I can skip that one because it's really a very schematic description of the difference between alignment methods and climate stress tests. Thank you very much. So moving on to what the core of what we've been doing in the paper that was published in December. The experiment, because I should stress that I didn't do that at the start of the presentation. It's really an experiment. If I in my talk I talk about an approach or a solution or whatever, it's de facto what the paper is about. It's an experiment. So maybe next slide. Before getting into the details, just a refresher on some of the guiding principles that typically central banks' collateral policy comply with. One is market neutrality. And I should say that when we started our project, discussion on market neutrality were already high and thriving and quite sensitive. So this is really a key element in, at least in the Eurosystem collateral policy. A variant of this is what is called the residual risk equivalence, through which means that controlling for risk control measures, the residual value of an asset should be equal to another across asset classes. The second principle that is typically underpinning collateral policy is about level playing field across counterparties. At least in the Eurosystem, again, the way the collateral policy is designed, it is such that it does not create undue constraints on the ability of a given counterparty or bank to actually participate in monetary policy operations, credit operation. The third principle is about simplicity, operational efficiency. Just a quick word on that. Obviously, the more complex the solutions, the risk control measures are, and the more likely that errors may happen and that risks are not properly covered. So it may sound obvious, but it is an important one. And last but not least, obviously, collateral policy is also built on the notion that risk control measures should adequately protect the balance sheet of the central bank against risks it takes on its balance sheet, whether credit, market, or liquidity risks. So much for the refresher. Then turning to what we've been doing. The approach where we test in the paper, what we call the climate-hedging portfolio approach, entails three things. One is to identify what could be the relevant alignment methodology to capture whether assets or issuer contribute to the 2-degree target of the Paris Agreement. The second is it really takes into account how counterparty actually pledge collateral with the central bank. And the third, and that's the main point actually, is to to try to measure so-called temperature of the assets that a counterparty pledge as a portfolio, as a whole, at the pool level, as we speak in the Euro system. These contrast with other approaches, and including other proposals that have been published over the last few months. So this is not about haircuts. This is not about excluding assets based on climate-related criteria. But this is about leaving, to the extent possible, the counterparty's responsibility intact. It is really a key element when we thought about this approach. That was a really key criteria to think about an option that will leave the counterparty free to decide on which asset it would pledge with the central bank, subject to an aggregate constraint. Next slide. I should just, before moving on, I should just mention that in thinking about this climate hedging portfolio approach, we also had in mind what is the evolving practice in the private sector. As you may be aware, some funds in the industry are being developed that are 2-degree aligned. And so having in mind that the industry is moving in that direction, we thought that it might be a source of inspiration for the design of a collateral rule. So now going to the data. Next slide, please. First on the data sources. We use 2 providers, S&P Trucost and Carbon for Finance, both of which offer alignment metrics. The alignment metrics from S&P Trucost is a relative greenhouse gas emission gap calculated over a 10-year period. Carbon impact analytics provide what they call an overall rating, so it's more a qualitative rating rather than a sheer number. Difference between the two are many. An important one is that S&P Trucost calculate the gap I just mentioned based on scope 1 and scope 2 emissions and subject to a 2-degree emission budget that is based on the Science-Based Targets Initiative trajectory. By contrast, what Carbon for Finance does is to measure emissions across the full spectrum of scopes from 1 to 3. They also try and assess and estimate greenhouse gas avoided emissions by entity, and they capture in their metric some elements of the business plan, the capex. They look at the capex of each issuer and assess whether it is consistent with the 2-degree target. The sort of number that you get is very different. For S&P Trucost, you have a percentage, while for Carbon for Finance, you just have this qualitative score ranging from 1 to 5. Next slide. I'm trying to speed up. In terms of coverage, because that was another motivation of the paper, of the project. When we started, the buzzword was, you don't have the data, you can't do anything. And we thought, okay, maybe that's the case, but just have a look at the data and see how far we can go. And so a sort of first interesting finding is how relevant the data based on these 2 providers are from a central bank perspective, like the Euro system, who's accepting quite a vast range of assets as eligible collateral. And there, the result was rather reassuring in a sense. Obviously, the data coverage is not perfect, and that's apparent on the table on the right side. For the eligible universe, it is more or less 80%, so it's not complete, but it is quite significant as a matter of fact. So that was quite interesting to uncover. I should say that these figures apply only to marketable assets. And when we looked at pledged assets, there the figures were a little bit less comforting, because as you see, it's a little bit less than 2/3 of the assets that could actually be assessed based on these two providers. There's one thing I should have mentioned on the previous slide. Why carbon for finance and why true cost? Well, the reason is really simple. It just is that Banque de France, in its own portfolio management, already uses these two providers. And they were picked for really non-monetary policy reasons. So it's just that we had subscriptions with them, and looking at various surveys, these two appear to be some of the relevant players in this field. But I should stress that although we found these the two providers and their data useful, the paper should not be read as validating or endorsing these two providers. And I should, as I'll mention at the end of the talk, further work needs to be done using other providers. One last word on coverage. We've done our study in May last year, and the fact is that since then, I know that both providers have increased their coverage, and now the figures on the screen would be much higher. Next slide, please. So applying these two, the metrics provided by these two providers, what was the sort of stylized fact that emerged from using them on actual collateral data? Well, the key message, and that's probably an obvious one, but then here it is documented, is that the eligible collateral is not 2-degree aligned based on true cost data. What you have on the screen is the cumulative distribution across for three asset classes: corporate bonds, credit institution bonds, and financial corporate bonds. And as you can readily see, the vast majority of the assets, eligible assets, are beyond the zero threshold, which would be, using true cost data, the reference value signaling alignment with the 2-degree path. Another point that arises from this graph is that bank bonds are typically rather well aligned compared to others. You see on the table on the right that the average emission gap is significantly more below that of the other two asset classes. But as you probably have already guessed, this is mostly the result of the way true cost computes emissions, as it uses only scope 1 and 2, and that de facto sort of give an advantage, if I may say so, to credit institution in terms of from a pure computational perspective. Next slide, please. So this is the same graph, but using carbon for finance data with one asset class on top, which we could not get from true cost at that time, but I know they can provide that. And that additional asset class is central government bonds. And there the results are, between 10 and 15% of the eligible corporate bonds are 2-degree aligned, but none of the bank bonds could be considered aligned. And that 25% of the corporate bonds are worse than the benchmark. So here again, the same message, the eligible collateral is not aligned. So next slide, please. The point that really comes out of this comparison between the true providers, that the form of the distributions are not completely similar, and that given the sheer methodology of each of the provider, the results for asset classes are quite different. And as I mentioned, credit institution is really a striking evidence of that. So what we document is that the choice of the methods is really critical from a policy perspective, from an instrument design perspective. So that means, and I'm sort of anticipating conclusions. I anticipate I will not have time for a conclusion, that more work is needed on comparing the various methods for measuring the alignment of eligible assets. Next slide, please. What we've done also was to look at pledged collateral to see whether there is the stylized fact, that document I just indicated, that eligible universe is not 2-degree aligned, is different when it comes to collateral that is actually pledged. And there the very striking fact that irrespective of the provider, irrespective of the asset class, the shape of the cumulative distribution is very similar to the one I just showed for eligible collateral. So that in a sense is an indication that there is no carbon selection bias in the mobilization behavior of counterparties of the Euro system. Next slide, please. What we also do in the paper is to look at the pool level. And there, what is made apparent is that there is high heterogeneity in terms of composition or alignment of temperature of counterparties pool across the whole universe of counterparties in the Euro system. And what we also show is that for a significant range of counterparties, we actually have a decent coverage of data. But again, the actual alignment is really, really diverse across counterparties. Next slide, please. There, I'll just take 5 minutes to discuss a little bit some of the implications, policy implication or instrument design implication of what we've been looking at for the past few months. One is that a mobilization rule that would subject a collateral pool to a form of alignment rule could be one way to address climate-related risk in the collateral framework. It is probably more flexible than other measures in a sense that you could phase in that kind of requirements over time to allow counterparties to gradually adjust their behavior in terms of mobilization. We tend to think that this approach is probably less normative than green-brown haircut or a green-brown eligibility criteria. In a sense, it avoids the central bank taking a stance on which issuer, which asset is more brown or less brown than the other, which may expose the central bank to some criticisms or various problems. Next slide, please. In doing the project, we also highlighted or discovered a couple of methodological caveats. One is obviously related to data. As you've seen, the coverage is not perfect, so we are missing some issuers, some asset. The question is whether it is material for the central bank to cover the full spectrum of its eligible universe. We also have identified that there is no single definition of alignment, and indeed further work's needed on various methods for measuring alignment. And in trying to aggregate the alignment value at the pool level, we discovered that there that's quite obvious, but there are many ways to do it. And then from an instrument design perspective, you need to have a clear view on what's the best way, whether you take the median, the average, or other variants around that. And I see that Pierre is appearing on the screen, so he probably wish me to finish, and I'll try to, I skip the conclusion and just go to the next slide. Just to mention that we have also tried to assess whether such a constraint, a 2-degree alignment at the pool level, would be, how harsh that kind of constraint would be on banks' ability to pledge collateral and get credit for and liquidity from the central bank. And there, from the results are a little bit different depending on the provider. So that also highlights again that you need to have a thorough review of the various methods before getting into the design of an approach. But we also document that it's probably feasible to improve the, so to speak, temperature of the eligible universe or the pledge collateral. What we've not been able to look at, and that's probably a very critical point, is when imposing that kind of constraint, what would be the market impact of doing this? Our intuition is that when you do that as a central bank, you leave banks free to pledge or to compose the pool of collateral. So in a sense, you're leaving market forces to price differently different assets based on an aggregate constraint. But that's more an intuition than anything. And whether that the market impact might be severe or possibly disruptive needs to be assessed. And I stop there. I had a few slides on the conclusion, but we'll have a chance to discuss that later. Sorry for being too long.
Thank you, Pierre-François. I guess that appearing on the video is the new way of showing you a 5-minute time tag to tell you to conclude. So I just wanted to give a bit of time to ask some questions. So if the audience asks questions, you can write them in the chat or in the Q&A section or raise your hand. There is already one that I think is key, and Colleen Schneider is asking you to explain a bit further what do you mean by non-neutrality in terms of residual risk equivalence. And I think this neutrality issue is at the core of a lot of discussion. So maybe I think your point of view is quite interesting, saying that neutrality is on the residual, not on every choice.
That's a it's a very key point. There is a distinction, I think, between market neutrality and residual risk equivalence. And to be very direct, we don't claim that through this approach you would comply with the risk residual principle, the equivalence of residual risk. But we do think that you're making quite some steps toward market neutrality, in the sense that, again, as I just mentioned, as a central bank, that kind of approach would avoid taking a stance on who's green, who's brown, and leave that to the bank, subject to a metric that needs to be as objective, transparent, reliable, and so on. So the key point about the residual risk equivalence principle is that as long as you're not using a monetary value of risk, it's very hard to comply with it. And as we do not use a monetary value of risk, it is obviously possible for that kind of approach to be completely consistent with this principle.
I mean, you have emphasized a lot the need to choose the right metrics and to carefully understand it. That's also something that we have observed in one study on actually financial, not alignment metrics, but climate risk exposure metrics. And in our conclusion, we like say that it would be it's easier to rely on a set of metrics rather than just to focus on one and having a chance to or a risk to take the wrong one. Wouldn't that be possible? I mean, no, the ECB is using 4 rating agencies, and just one needs to be fulfilled. Wouldn't that be a possibility to avoid fixing one single metrics?
That's a very key point. As you mentioned, I mean, it's at least from a Eurosystem perspective, I must say I don't know what is the practice in other central banks, but it is very standard to use various sources when it comes to measuring risks. So yes, the short answer is yes. The more complex question is, when you say different metrics, do you mean, you know, using a WASI and, you know, the raw numbers or the raw tons of emissions plus an alignment metrics, or various, you know, alignment metrics from different providers, but still only alignment metrics? So, and that's probably an open question. And the other big open question I think is whether from a risk perspective, given the current state of knowledge, we are, as central banks, confident enough in the data to use directly climate-related data, and not to try and get more standard risk measures. That's a very important step to take for a central bank, and I guess there further work is needed.
Sorry, was muted. There is one more question about still about the benchmark. Why not using the EU taxonomy that is being developed? So is that something that could be also useful for you, or I mean, my feeling is not.
Yeah, I mean, again, it's an experiment. It's not. We are not claiming that's the end of the story. I must say I'm not aware of all the details of the taxonomy. In principle, it's probably useful to design collateral risk control measures. In essence, still, you know, it is a taxonomy, so it has the values of it and also the drawbacks of it. So it is less dynamic than the kind of metrics that we've been looking at, or that, you know, credit rating agencies, their metrics are evolving over time. So my hunch is that some of the indicators that are used in the taxonomy may be useful, but then we need to have a thorough look at the whole taxonomy before embarking it into collateral rules. But again, that's really an area where further work is needed, I think.
Another interesting remark by Stephen Cecchetti is on the definition of neutrality, in a sense. So he is pointing out that high carbon industries tend to issue more marketable debt than the rest of the economy in proportion. So in a sense, the central bank should bias their collateral policy to make it carbon neutral relative to the economy, and not relative to marketable debt. I mean, first, is it true that they issue more, and then wouldn't it be a good justification for market neutrality?
That's a very critical point. I think it's true, but you probably need to check that across jurisdictions. But yeah, I suspect that the largest company are present in the market, are financed in the market rather than through credit bank credits. And then the second point, in a sense, that refers to what is the motivation of your action as a central bank trying to capture climate-related risks. Maybe I'm wrong, but I think the way you just characterized it is more a proactive stance from the central banks, having a bearing on the transition towards a carbon neutral economy. These are, you can make very valid arguments in favor of that. The thing is that it may depend on the mandate or the interpretation of the mandate then. So it may also expose the central banks to more challenges, legal challenges possibly. While if you address the climate question as a central bank from a risk perspective, you're much less susceptible to being challenged as overstepping your mandate.
Another question on credit rating agencies. So the question is, are credit rating agencies likely to adopt a robust methodology of climate risk quickly enough? Or will it be faster for the Euro system to develop their own climate risk assessment? And that's also asked the question on the long run, on the reliance of ECB on credit rating agencies, at least for corporates.
Yeah. That's the short answer is I don't know. I mean, there is work ongoing about understanding how credit rating agency capture climate-related risk into their ratings, credit ratings. As you know, some of them say that they do, and that it has an impact, but not as material as people would expect. I guess work is really needed or dialogue should be engaged with the agencies to review that in some depth. Then again, one of the premise of our work is really that there is something special about climate-related risks, which make it a little bit more difficult than your typical financial risks to be measured. These uncertainty questions, tipping points, non-linearities, which make it very difficult in our sense for markets to price in. I'm quite sure that the more you give data to markets, the better they will price something that is close to climate-related risk, but probably not the full scope of climate-related risk. I guess that kind of reasoning also applies to rating agencies, although they could run a scenario analysis and to come to their rating. And then the timing question, that's a really that's a policy question. I can't say more about it.
I just realized that we're reaching the end of the hour and I haven't let Romain speak at all. So if you want to say something,
very clear.
I'm so sorry, Romain.
No problem.
If you want to say something now, it's now or never.
Well, thank you very much first of all for raising. I think in 1 minute, perhaps just responding to the question that Gabriela Mundaka asked. I think about transparency in terms of disclosure. I think this is in any case, whatever the methodology used is, I think it's an extremely difficult one, and we can see that in French with the Article 173 that compels financial institutions to disclose, and we see that it is extremely difficult to understand how they disclose, on which basis, etc. So I think that this is something that central banks will not be able to solve on their own, but it is a challenge, whatever avenues taken. And I'll stop here because I see that we're already past our time. So that's my only contribution.
Thank you very much. Thank you, both of you. It was a very interesting seminar to start the year with. Let me just remind to the audience that there is another webinar coming on Monday, I think 8th of February, where Alessandra Ferrari from the Banque d'Italia, or I think ECB now, will speak on the possibility of Greening Unconventional Monetary Policy and presenting their paper there. Please also remember that you can join the discussion on Slack, where there is a dedicated forum to speak and exchange information about climate change, central banks, and financial sector every day until the next seminar. I think we will present the result of the poll in the Slack, because we didn't have time to address it now. Thank you again, Romain and Pierre-François, and for all the others, see you in 2 weeks.
Thank you very much, Pierre.
Thank you. Bye.